The principle of buy low, sell high is a fundamental concept in investing and trading. It essentially means purchasing a stock or any other financial asset when its price is low and selling it when its price is high to make a profit. However, successfully executing this strategy is often easier said than done due to the unpredictable nature of the stock market. Here are some strategies and tips that might help you buy low and sell high. Fundamental analysis. This involves analyzing a company's financials, industry position, and market conditions to predict future performance. You might buy a stock at a low price if you believe the company is undervalued compared to its intrinsic value. Technical analysis. This approach uses statistical trends gathered from historical trading activity, like price movement and volume. You look for patterns or indicators that signal when to buy or sell a stock. Dollar cost averaging, DCA. Rather than trying to time the market, you invest a fixed amount of money in a particular stock at regular intervals. This approach ensures that you buy more shares when prices are low and fewer when prices are high, reducing the risk of making a substantial investment just before a price drop. Contrarian investing. This strategy involves going against prevailing market trends. For example, you might buy stocks when other investors are pessimistic, prices are low, and sell when they are overly optimistic, prices are high. Value investing. Popularized by Warren Buffett, this strategy involves buying stocks that are undervalued compared to their intrinsic value and holding onto them for a long period of time. Set your goals and limits. Decide in advance what price you are willing to pay for a stock, and at what price you are ready to sell. This can help prevent emotional decisions. Patience and discipline. Timing the market perfectly is nearly impossible, even for professional traders. Patience and discipline are vital for success in the stock market. Diversify. Having a diverse portfolio can help mitigate risk. This way, if one investment performs poorly, others may perform better. Regular monitoring and adjusting. Keep a regular check on your portfolio, market trends, and news that might affect stock prices, and it's essential to adjust your strategy according to changing circumstances. Do thorough research. Consider seeking advice from financial advisors or investment professionals before making any major investment decisions.